Record-breaking stock indexes, a surge in AI spending, the Fed's growing rate cut odds, Trump's tariff surprises, gold markets chaos, and even a potential Alaska summit sometime soon between Trump and Vladimir Putin. Let's get into all of it today. So the Nasdaq 100 closed up 1% today at market close, and that is the 18th record close just this year. And that's also up 3.9% as far as gains for this week, the best performance since late June heading into August, which August was noted to be a tough month for the Nasdaq and the S&P in particular. The S&P 500 rose 0.8%, just shy of fresh all-time highs, and the Dow Jones also in the green territory, adding about 0.5%. And a lot of people are wondering what's driving this rally these days, and it's still big tech's relentless momentum adding to it with strong corporate earnings and the AI boom, all while investors are largely shrugging off tariff headlines that just seem to show up brand new each and every single day because it never ends. But speaking of President Trump's sweeping tariffs, they officially took effect this week, covering imports from dozens of countries. Yet we will see what the overall reaction is as time goes, but so far Wall Street has barely flinched. Now, why is that the case? And some point out that companies are still winning over exemptions, like Apple being a recent example, and many imports remain duty-free due to trade diversions and reclassifications and handshakes behind the scenes. Barclays estimates the effective U.S. tariff rate is about 10%, even though the headline numbers sound much higher than just that 10%. But there's a warning here. Barclays expects that the rate could rise to 15% in Q3 of just this year. And if the exemptions begin to fade away, the economic drag could intensify and the economy could begin feeling the heat. Now, I thought this one was interesting because JP Morgan's top US economists now expect 3 Fed rate cuts in 2025, starting with the 25 basis point cut in September. Now, why is this the case? Where did this shift begin? And it all started with Trump's nomination of Stephen Moran, one of the two, to the Fed board could tilt the committee toward easing as far as more people supporting rate cuts. And governors already dissenting in favor of cuts in July, just adding to the favorable rate cuts that it seems everybody's mouth watering over. If August's jobs data shows unemployment at 4.4% or even higher, we could even see a 50 basis point cut or a 0.5% off of the Fed funds rate, which is where it's at. This is unusual though, because cutting rates with stocks near record highs and inflation above the 2% target is rare in Fed history and goes against everything they've been telling us. But the second quarter AI spend may have powered nearly half of the GDP growth, and it could continue that way. Tech giants like Amazon, Microsoft, Alphabet, Meta, they spent $69 billion in Q2 alone, or 276,000 billion annualized, so 1,000 million. Some economists see this as a multi-year productivity boost, while others caution that this much spending is pretty much on Nvidia chips and other imports, meaning that the domestic impact could be smaller than a lot of people are suggesting it could be, or maybe just saying, hey, y'all are kind of over optimistic about where we could go with this. Now, as strategist Callie Cox puts it, AI is going to go gangbusters, but without strong consumer spending, the economy still doesn't thrive. So we'll keep on watching where we go. We talked about this one hints as far as economists warning of potential stagflation, warning that inflation is set to rise due to these 3 main forces, like a falling dollar making imports costlier, restrictions on the migrant labor pushing wages up because now Americans are working these jobs that usually immigrants would have worked for lower pay, and Americans were known for wanting high wages. We spend a lot of money, so that explains why the wages are going up. And then the third reason is higher tariffs feeding directly into prices. And the economists suggest that Fed Chair Jerome Powell, the tenure could be short if he resists political pressure to slash rates, and this could steepen the yield curve, pushing long-term treasury yields much higher relative to short-term rates, a scenario that historically benefits big global tech stocks but hurts pretty much everybody else, like these debt-heavy US companies and even consumers who are debt-heavy because borrowing costs get more expensive as yield curves steepen. But in a surprise move today, US Customs and Border Protection ruled that Swiss gold bars, 1 kilo and 100 ounce sizes, will face tariffs under Trump's trade plan. Given Switzerland's dominance in refining, this could raise costs around the $5 trillion global gold market. UBS strategist Joni Teves says it could force changes in how gold is delivered and settled, and central banks, and especially China, may ramp up gold buying as a hedge against U.S. policy unpredictability. Unpredictability just never ends. I've been saying for a while, the word of this entire year, or maybe this entire presidential term, is uncertainty, and that's where the negotiation leverage comes in. But speaking of negotiations, there's a huge meeting supposed to take place. So finally, a geopolitical curveball. Russian President Vladimir Putin has offered a ceasefire in Ukraine in exchange for major territorial concessions, seeking global recognition of those claims. We don't know how it's going to go, but so far what we do know is that Trump has agreed to meet Putin in Alaska on August 15th to discuss the proposal. A move likely to draw both domestic and international scrutiny, but we'll see how this goes. So, this week's story is one of resilience. Strong record highs, strong earnings, big bets on AI, but also under the undercurrents, a weird way to say it. There's rate cut politics, trade, tariff tensions, inflation risks, and geopolitical uncertainty. We got to keep on watching all of these because these forces could shape where the economy goes, what happens, the markets, and even your portfolio if you're the one that makes those decisions. So if you found this breakdown valuable, help me out. I'm almost 200 subscribers. I don't get a whole bunch of likes on my videos, but I want to keep on going. Drop a comment with your take, what I need to talk about, where I could sharpen up at, especially on AI's role in growth and the Fed's next move. We could keep this conversation going, y'all. Hope your night's great, and I'll see you in the next one.